Hi, I'm Jeff Tucker, Principal Economist at Windermere Real Estate, and these are the numbers to know right now. I'll start this month by checking in on one of the most important numbers for the real estate industry, existing home sales. Now, they actually surprised slightly to the upside in May when closed sales ran at an annualized rate of 4.03 million. That's ever so slightly higher than April's figure and ever so slightly lower than in May of 2024. But in both cases, that's less than a percentage point of difference. So let's just call it roughly flat. And flat pretty much sums up existing home sales for the last couple of years. Outside of some seasonal outperformance this past Q4, we've really just been bouncing around an annual sales rate of about 4 million. Now, zooming out to the last 30 years helps put that in perspective. 4 million existing home sales puts us right around the lowest lows of the home sales in the Great Recession. Now, this lack of turnover is being driven by affordability challenges on the buyer side and the lock-in effect for sellers who don't want to give up their low interest rates they got in 2020 or 2021, as well as the aging of the US homeowner population. Older folks just don't move and sell as often as younger households. Now, that doesn't mean no one is trying to sell. And in fact, the month of May ended with over 1 million active listings on the market, according to Realtor.com's data, bringing the market very close to pre-pandemic inventory norms. In fact, the National Association of Realtors reported that when they measure inventory in terms of months of supply, it actually exceeds its May 2019 level. And that's basically being driven by the fact that fewer homes are selling today than they were in 2019. So this inventory level relative to sales is actually looking closer and closer to a buyer's market. Now, speaking of sales, if we want sort of a peek ahead, checking in on pending sales shows that those rose just under 3% in May year over year. That's an early indication we may see some modest year-over-year gains for closed sales in June, but the market is still looking quite sluggish. Now, turning to the macroeconomy, we got yet another good, surprisingly cool CPI inflation report for the month of May. The annualized monthly growth rate of prices was almost exactly 1% annualized, and the year-over-year change in CPI from last May was only 2.35%. That metric has been inching down closer and closer to the Fed's goal of a 2% inflation rate, which is part of its dual mandate, along with pursuing maximum employment. Now, speaking of interest rates, it's been another pretty quiet month for mortgage rates, which are once again stuck in a range between 6.75% and 7%. I know it's been a busy news month, but mortgage rates mostly took it all in stride, drifting down slightly in the last couple of weeks to end up basically where they were at this time last month. Now, the Federal Reserve met in June and they declined to change their overnight Fed funds rate at that June meeting. There is growing pressure, though, to resume cutting rates soon if inflation remains as muted as it has been this spring. Now, personally, I still think the Fed will wait till there's clearer signs of labor market deterioration before cutting. Moreover, I think a growth slowdown is probably what bond traders need to see before long-term yields like 10-year treasury yields and therefore 30-year mortgage rates also fall substantially. So that is some of the information that we need to look out for in the months ahead. All right, that is all I've got for this week, and thank you as always for watching.